City Index. This is my weekly wrap where I go and look at a variety of different markets and the key macro drivers, not only what we've seen this week, but then also in the week ahead. I thought today I'd do a focus on US rates and the US dollar because, let's be honest, they are the key building blocks amongst so many different trades out there right now. Before I go and get into it though, I'm going to go and put up our disclaimer here on the screen because what I want to do is try and make this as interactive as possible. So over the course of my talk, what I want you to do, if you've got any questions, please feed them through on the platform, and then I'll endeavor to go and answer them at the end. I'm not afraid to go and look at any particular market or anything like that. So if you've got a question, you want to get a view, please shoot it through. And I appreciate to go and do that because I do want to go and make it as fun for everyone involved. Well, with that, let's get straight back into it because it's been a pretty interesting week to say the least. And then I think potentially it was really interesting what happened last night, particularly with some of the data we've seen in the lead up to last night. Lots and lots of US dollar strength, lots and lots of increases coming through in US Treasury yields. And that's been underpinned by very, very strong US economic data, including last Friday, that blowout non-farm payrolls report that completely obliterated all the bearish kind of tone out there at the moment. But potentially, and I want to reinforce this, temporarily, things might have changed in the near term. This is what came out last night. Initial jobless claims. I'm not sure those of you who've kept up to news with what happened overnight. Jobless claims in the States. So the first time unemployment benefits claimants, when it increased by the most in over a year, 258,000. It was above every single economic forecast that are out there. And created a bit of a shock. There was some anticipation that Hurricane Helene was going to go and have an impact, but it was 20,000 above expectations. And as you can see there on that chart, a big spike coming through. And it's interesting to go and see that in the context of what's been happening weather-wise in the States right now, and of course probably more acutely about 24 hours or so ago with Hurricane Milton. Now when you think about what we're looking at on this chart here, it's difficult to say that we won't see something potentially very similar to what happens next week with Hurricane Milton's impact. So we could get back-to-back big increases coming through in initial jobless claims, which we know is going to be pretty important because the Fed has programmed traders, it's programmed investors and markets more broadly to focus on labor market data. And whilst it would be temporary in nature and it should be expected there'll be disruptions, that's not likely to go and dissuade markets from going and acting upon it, as we saw last night. So a big increase coming through in jobless claims. Counteracting that though, we also got the US Consumer Price Inflation Report out. And what you're looking at right here is the month-on-month change in the core rate. Now, it came out last night at 0.31. Too hot to handle. And if you look at the end of that chart and you look at what direction is traveling, we have now seen 3 sequentially higher increases on the prior month coming through. And at 3.3% annualized, it's becoming too hot for the Fed to ignore. Yes, this is not its preferred inflation measure. That's the core PCE deflator, and we'll get some more inputs for that later on tonight with the PPI report out in the States. But this is a trend that should be concerning the Fed because it has gone and instructed markets to go and focus almost solely on the labor market. Now, it's not going to have a lot of visibility on the labor market, actual trends, not temporary disruptions, for quite some time now, you'd imagine. And all at the same time, we're watching inflationary pressures pick up. Now, the problem that we saw last night was not just that we saw a 0.31% increase in the monthly rate, but the detail was pretty concerning as well because no longer was it really just a story of owner's equivalent rent and rents, which are the 2 biggest components in the US CPI basket, but it was broad strength. Core services ex-housing up 0.4, highest increase since April. Core goods, so goods prices have been deflating, disinflationary pressures or deflating outright for quite a period of time, and they picked up pretty aggressively too. And that's concerning because that's filtering through again into the inflation trajectory. But right now, the Fed can't go and pivot straight back to talking about inflation, and we haven't seen enough evidence yet. But I've got to say that what we're looking at right now looks eerily similar to what we saw at the start of this year, where the markets went really, really hard, got aggressive when it came to the number of rate cuts that they priced in, almost 7 over the Fed over the remainder of 2024. And then the data came out and then really forced the market and forced the Fed to backtrack on those views. It's too early to go and tell right now, but it has that feeling about it. Services inflation is not going away. We saw in the payrolls report last Friday that wage pressures are still very, very strong as well. And that feeds into that services inflation story. Now, what did the market reaction do? Well, what you can see here on your screen are two different panes. On the left-hand side, it's US inflation expectations. It's inflation break-evens 10-year. So what does that mean? It means this is what the market expects the average annual inflation rate to be over the next decade. And I've highlighted the part that's really interesting, because what we've seen recently is that the expectations got down to the Fed's target around about 2%, and then all of a sudden they have jackknifed higher. And at 2.33% at the moment, that's over the course of the next decade, that's becoming uncomfortably high. And not to the point where you start talking about inflation expectations become unanchored. But if you look back on that pane and the chart to earlier this year and in periods in 2023, when the rates are up this high, the Fed was not talking about cutting rates. The Fed was talking about being patient and even potentially hiking rates. Now, we're not at that stage right now, but you can see the markets are getting twitchy about the prospect that the Fed will not go and finish the inflation fight right now. And that's despite what we're looking on the right-hand pane, which is market expectations for rate cuts from the Fed, the magnitude of rate cuts expected according to Fed funds futures out over the next 15 months or so. So right now, markets have already curtailed the number of bets, rate cuts that they had priced in from around about 9 at the start of last month to now less than 6. And you can see the trajectory is pretty obvious right now. We're seeing a big curtailment of that. And despite the prospect of less rate cuts coming through, inflation is still picking up. Now, there's an element of what's going on with crude prices, energy prices more broadly, potential China stimulus and the like. But this is the market saying that it's uncomfortable, that even with the curtailment in rate cut bets that we've seen recently, they don't think it's going to be enough to prevent inflation from going and potentially starting to go and pick up longer term. So that's the picture we're looking at right now, because the Fed has been really instructive in telling us, keep looking at labor market data. That's where the focus is right now. Whereas the markets are now clearly starting to go and look at the inflation side of the story, given we're seeing that trend in that core inflation rate. And they're saying, well, hang on a second, maybe you're wrong again, like you were late last year when you pivoted towards signaling rate cuts. Now, the key thing now to look at is what happens next. We're not going to have a lot of visibility when it comes to accurate labor market data, in my opinion, probably for at least a couple of weeks. And the problem we're going to have as well when it comes to the October payrolls report is that the disruptions caused by Hurricane Milton just happen to occur in the week when we get the reference week for that report. So we're going to have a dog's breakfast. We're not going to go and get any real clear insight you can imagine from that report, given the disruptions that we've seen in Florida. There'll be attempts to go and strip out the impact of that, but it's going to be a mess. And when it comes to the risks, the risk for me will be that we get another weaker print coming through. Now, what we've been looking at with markets, we're talking about higher US yields, higher US dollar. That's what the trend has been over the past couple of months. If we start to go and see weaker US data, which is the thing that the Fed is telling us to go and focus on relentlessly, well, that potentially points to a reversal in both the buck and US yields. Let's go and switch over now and have a quick look at what's been going on. I want to go and start off with the US dollar index daily chart. Now, it's not a readily traded instrument, granted, but it does give you some pretty good signals. It takes all the other various components, particularly what happens with euro and the Japanese yen. And you can see here on the screen that we've had a really strong and powerful rally here, so much so that we've actually gone and broken this downtrend and also the 50-day moving average here. And you can see done away again with downtrend resistance as well that had gone and capped prices earlier this year. And then it's actually going to manage to go and reclaim this uptrend. Now, this uptrend goes back a long way. You can see back to the lows that we saw around about the middle of last year. And it's managed to get a foothold above that, broke through, came back, tested it a couple of times, and then you can see here, it's managed to go and break higher. But then on Thursday, that mixed data set, hot inflation, pretty ugly inflation, initial jobless claims data that was coming through. So kind of offset each other. And you can see here, the doji doesn't really go and give us a signal one way or another, but we've seen a big, powerful move. And until proven otherwise, that is the path of least resistance. It's towards US dollar strength. However, what I'm paying close attention to go and drive the US dollar is not so much what's going on with the technicals on the DXY chart. It's what's coming up on this next one here. Let me go bring it up. The US 2-year note future. For those of you who follow me on X, I released a video about it yesterday, and we've seen a really, really interesting reversal over the course of the last 24 hours. So when I was writing that note, what we're looking at here is that the price had broken lower and then was sitting around about here. And I said, if we were to go and break meaningfully below this 50-day move, sorry, the 200-day moving average, that brings us into the territory where we're talking about higher US yields and the like. But look at the reversal, big downside wick. And you can see here, the hammer candle that's being presented has actually gone and pushed the price back up into this uptrend that it had been sitting in. Now this particular chart has been contract adjusted to better reflect where volumes have been going through, because when you go and just do it on a monthly roll basis, it becomes really kind of not much information. But the signal from this is telling me that look out for a potential reversal in the US dollar. Not just because what my insights and my gut feel that potentially we might see some weakness coming through in US labor market data in the not too distant future, but also this reversal here is telling me to be careful. So you can go and look at this chart. ZT1 is the code for those of you who use TradingView, but you can go and find it in a lot of places. You can even go and look at US 2-year treasury yields. That will go and give you a kind of similar picture as well. But keep a close eye on the price action here, because what we've been looking at is that US 2-year yields have been incredibly important for markets recently. And just to go and demonstrate that point, I went and was looking at this chart yesterday. So we've got two panes again, but it's both the same thing. So it's looking at the rolling 10-day correlation between US 2-year treasury yields with a variety of different metrics. We've got gold, and it's over the past 10 days. And you see gold, silver, copper, crude oil, dollar yen, dollar Swissy, dollar Chinese yuan, Aussie US, Kiwi, Euro, sterling, and the DXY. And that's the one that I really want to focus on now, because at 0.92 over the past fortnight, what that signifies and what it signals is that more often than not, we're seeing the DXY, the US dollar, is moving in the same direction as US 2-year treasury yields. So if that reversal that we've seen take place on Thursday sticks and we see this price starting to go and push higher, potentially on the back of some weaker US data, that points to lower dollar, suppression of all of those currencies and commodities that have been pretty hammered by the US dollar strength we've seen over the past couple of months could be released. Because when you look at what's coming up on the calendar as well, I've got to say there's not a lot. Let's have a look at the calendar right now. This is next week. Let's have a quick look at what's going up tonight. We've had the big act already this week with the inflation report. But tonight we get PPI, which will go and feed in. Components of that will go and feed in to the core PCE deflator. Right now, the way things stand, it looks like that Fed's preferred inflation measure is going to print somewhere between 0.2 and low 0.2s when it comes through for September later on this month. But we'll get a better insight as to exactly where it will print based on what comes off with the PPI later in the session. Apart from that, there's not a lot to go and kind of hang your hat on. Yes, there's continued speakers. Goolsbee from the Boston Fed has been relentless. I don't know where he has time to go and do any economic analysis because he's doing so many media interviews at the moment. But realistically, the Michigan Consumer Sentiment Survey might get a bit of interest, particularly around the jobs market, because we know that's what we're being programmed to go and look at. But inflation expectations as well will be something to go and keep an eye on, given what we're seeing when it comes to gasoline prices in the States, petrol prices here in Australia and Singapore. That is going to be the areas to go and look at. Realistically, though, there's not a lot else. Monthly budget statement, well, I can promise you it's probably going to be a continuation of those pretty ugly trends. We can see here, based off tax receipts, a surplus is expected on this occasion, but you can tell the trend has been pretty bad when it comes to annual basis for quite a period of time. And the structural deficits in the States are something that's going to be something to monitor over the longer term. Let's have a quick look now at what's coming up. Columbus Day, don't worry, the bond market is shut, so my world's closed for the day, but other markets, including US equities, are open on Monday, so don't worry about that one. When it comes to some of the other things, I've got to say that the week ahead is looking pretty quiet when it comes to major data. Yes, more Fed speak, a lot of Fed speak coming through. The Empire State Manufacturing Survey from New York, consumer inflation expectations, but there's not a lot to go and hang out on. Export prices, maybe feeds into inflation expectations, but no, not really. Until you get to Thursday, and then you get that jobless claims print. Now, what Milton's going to go and dish up when it comes to the Florida claimants and broadly across the Gulf states and the US, who knows? But the risks are that it's going to be pretty ugly, as we've seen previously. So to me, when it comes to the US economic data calendar next week, that is the key event to go and keep an eye on. Later on Thursday as well, you can see we've got retail sales as well, industrial production data. All the figures you can see here in the times are for Australian Eastern Standard Time, if anyone's wondering at home. So they're the key ones to go and look at. Retail sales will give us a sense as to the strength of consumer spending. But given what we're looking at right now, that comes across as a more secondary release in relation to what's going on with the jobless claims data. So to me, that's going to be the really key thing moving forward. Let's have a quick look elsewhere at what we're looking at. We'll go G20 and we're going to go have a quick look at the what's coming up when it comes to the top events to go and keep an eye on next week. You see here, there's quite a bit coming up. ECB interest rate decision is now almost carte blanche that they'll go and cut an additional 25 basis points. The signaling will be more important. Will we see a follow-up cut coming through in November? That will be the key one to go and look at, in my opinion. Actually, it'll be early December, I should add. When it comes to other things, lots of inflation prints. Canada, the UK, and closer to home in New Zealand as well. We'll go and get theirs, which might go and give us a bit of a read-through as to potentially what we might expect to see in Australia, although the read-through isn't always the best at time. But realistically, unless you're trading dollar CAD, unless you're trading cable and things like that, Kiwi dollar, it's going to be about the US data flow. That's going to be the primary driver of things next week. So that's what I'd go and advise. From a framework perspective around your trading, keep an eye on the US data flow. That's going to be more influential than almost anything else that you can go and look at. One thing I want to go and look at quickly from a charting perspective is what's been going on in crude. Because when you talk about inflation, you talk about impediments to global growth and the like. That is a really, really big one. And it's been incredibly volatile over the past week. Now, I've seen so many different narratives to go and explain exactly what's going on. And even last night, you can see this big bullish bar that went and printed. The first thing I read was, it was concerns about a potential escalation in the Middle East conflict. Israel might launch an attack. We've been saying the same things for over and over for the past week or so, and it hasn't come to fruition just yet. It's not to say it's not, but it's not the headlines that are driving the crude price right now, in my opinion. It's the technicals, and you can see that here on the screen. When the price got reversed really aggressively during the week, that front came from a real long-running downtrend here, and you can see here also took out the highs that were seen back in August this year, and then reversed really aggressively. And I did warn at the time that they're potentially looking for further downside. It sliced straight through that uptrend, bounced off the 50-day moving average, and then what do you know? We've got a morning star here on the screen, and it's just gone and popped straight back higher again. And given what we're seeing, who knows? We're probably looking at another retest of this downtrend right now. When you look at things like RSI 14, it's trending higher. MACD is trending higher. So the inclination is to go and buy dips. The signals when it comes to price trajectory are pretty positive out there right now. Other things that I want to go and touch upon as well, really, really quickly, is the Chinese MOF statement, the Ministry of Finance statement that's going to come out at 10 a.m. in Beijing time on Saturday. Now, the markets are incredibly excited about this. And you can tell by what's going on with Chinese equities right now. It resembles a casino. It's all momentum driven. I've tried to go and apply some technicals to it, anything along those lines, and it's just useless. It is like going to the casino and watching the chocolate wheel and trying to go and do analysis on what might go and be spun up next. You don't know. And that's because we're being told to go and wait for this particular announcement after markets shut on Saturday, and then that will go and give us some clues as to what to expect. Now, I've seen a whole bunch of various forecasters, economists, analysts and the like talking about the size of the stimulus package that we might go and see. The counter-cyclical adjustment, as it's called, by the ML. And 2 trillion yuan, that's about 1.5% of Chinese GDP, all the way up to 10 trillion yuan, which is about 6% of GDP. Now, would be bigger in terms of currency terms than what we saw back in the GFC. It wouldn't be the same in terms of size of a percentage of GDP, but way, way, way too aggressive for what's actually required. Economic activity in China is not dropping off a cliff. That's the difference. It's not a global disaster that we're dealing with like during the GFC. So to think that we're going to go and get a GFC type era announcement, to me, comes across as a little bit ludicrous. I'll eat my own words, I'll eat my shoe if I'm wrong on that front, but I really don't think we're going to see anything that's going to be meaningful in terms that's going to go and turn up the dial. Now, how does it go and react with Chinese equity markets and all those markets that have reacted in response to what we might go and see? I'm talking about some of the cyclical stock indices around the world, commodities, iron ore, copper, WTI and the like. Well, I wish I could go and tell you, because at the moment, they're still really more interested in what goes on with Chinese equity markets, at least in the early parts of the Chinese session, than anything else. So it's difficult to go and interpret whether we'll see disappointment. But what we did see when the initial announcement came out from the NDRC earlier in the week, that really didn't go and give anything of substance, anything to go and back up those claims that we're going to see a big stimulus program. What we did see was lots and lots of institutional sellers coming in and offloading, likely to retail investors who have been moving in. That tells me that potentially we could go and see upside ahead, but if we get a bit of disappointment, as I expect from this announcement, if we do see any increase coming through in stocks, it may be best to go and follow the lead from the institutional investors rather than those who are trying to go and buy in the mad scramble just because we've seen a pullback or so on. With that right now, I'm going to go and put the disclaimer back up on the screen. And if there's anything you want me to go and cover off before I go and end the live stream, please go and shoot me through a question. I'll be looking for it right now. I'll come back in about a minute or so, and then we'll either wrap it up or we'll continue. I'll see you then. You must all be shy today. Don't be bashful. Those of you who are watching on demand, I'm sure there's going to be a lot. Mostly of the time we see a lot more people coming through in that particular mechanism. If you've got any questions for me, shoot me a question on X. @Scutty is my handle, and I'm happy to try and go and look into things for you. Until next week.